Hello, welcome to the Money and Finance podcast for expats. Great to be here. What a week it's been. Now let's bring Matt straight onto the screen. Just when you thought it couldn't get any more exciting, hey Matt, we've had a big
Yeah,
week
it's
globally, which I think you've got a comment on.
no. There's a bit to unpack this week. I was gonna keep it light on the investment side this week because we don't have Paul with us, and Paul is the voice of the investments, and we're building up to our big webinar next week, but we can't ignore what's happened. So there's quite a lot to cover. But yeah, it's been an interesting week.
Yeah, just in case anyone doesn't know what we're referring to there, the closure, the collapse of the Silicon Valley Bank, I say it came as a shock because in many ways, many people have been talking about the inevitability of such things, but then when it does happen, it is still a shock, isn't it? What's that all about?
Exactly, it does. It spooks people a lot. It comes as a shock. But then, yeah, you're right. When you unpack it, we think, well, we're all aware of you know the situation we're in as in the kind of worldwide economy. Um, and then when you analyze it and look what happened kind of behind the scenes and how they operated, which scares you. You think these banks, I know, okay, people see, Silicon Valley Bank, and it seems like, not your kind of traditional bank, but what they've done and how they operated and what kind of led to their demise is a little bit crazy. So, and we're trying kind of not go into kind of too much detail with it, but because we've all kind of read a lot about it. Um, but what really kind of entered was their kind of downfall was the deposit run. So a deposit run is a lot of the people who have their deposits or their cash holdings with the bank, they panic and they want to take their money back.
Yeah,
Um, so what initially triggered this, and we talk about bonds on this show quite a bit, and again this links into the increase in interest rates that we're having, which is a kind of theme of the moment and will continue. And so SVB, Silicon Valley Bank, they expose themselves to a lot of deposits. Sorry, bonds. And in simple terms, you buy a bond and it pays out whatever the interest rate was, a year ago. It pays out 1%. Then now interest rates are going up, so they're issuing bonds paying 3 or 4%. So no one wants to buy your 1% bond. So if you hold it to maturity, so the bond will have a particular length. These could be 1 year, it could be 10 years, it could be 25 years. If you can hold it to maturity, you're okay, because you hold it to maturity, you get your money back, you received your dividend or your interest in the meantime. Now, the problem arises is when you can't hold it to maturity and you're relying on selling that bond in the secondary market. Because, Carl, you want to buy a bond. Do you buy the one that someone's selling for 1%, is going to pay you 1%, or the one that's going to pay you 4%? No one's going to buy it. So the only way you can sell it is a heavy discount. So SVB, the problem is they had all these bonds, and most banks will hedge against interest rate rises. They didn't. So because they did it, interest rate rises, there's tightening of money in the economy. So these tech companies who deposit with them, they needed some of their money. SVB, they have to sell the bonds to get the money. They're losing money. People are panicking because they think these people can't give me my money back. Then
yeah.
the deposit run is everyone wants their money back. They can't service those payments, and then it's, yeah, good
Game
night.
over. Game
Game
over.
over. Exactly. And we talk about the tightening of the money supply, and we've got one image this week. Once
Yeah.
you got through that sneezing attack, Carl.
Yes, I muted you from that. Yeah, I don't,
we're,
don't know
we're
what.
very grateful for that. Yeah.
Yes, after 3 years we've been through, isn't it lovely to have the safe distance of the webinar? Well, the SVB thing certainly provides a brilliant backdrop for keeping your money safe, which we'll talk about a little bit later on. But yeah, you wanted to talk more generally as well about what's going on in the bigger picture. I think there's a budget today in the United Kingdom as well. Lots of interesting things
Yeah.
to keep everybody engaged and interested in the global money and finance situation. So there's that graph you wanted.
Yeah. So as I said earlier, we're not going to talk about the investments too much, and we keep saying we've got a hugely in-depth webinar which we're running next week, just before the podcast. So anybody interested in this sort of thing, sign up to the webinar. I think you'll be able to give the link later, Carl. But
Sure.
this is an image that we've shown before, which is the M2 money supply in the US. So this is the levels of money that's around, and the Fed have been doing what they call quantitative tightening, which is removing money from the system. And previously, post-COVID, they did quantitative easing, which is printing money, putting money into the system. So we can see the graph there, and we can see the peak, which is when they were printing this money. This would have been kind of post-COVID. And now they're tightening. But the key is that it is under that zero. So they're really kind of tightening. They're tightening to fight inflation. But the problem is, if we follow this graph, which unfortunately only goes back to 1959, it'd have been better to have one a bit further back where we can see the instances where this has happened before. But when it goes below that line, it generally kind of leads to recession. And now we've been below that line for a month or two now, and that's a big kind of warning sign. And when we talk on this podcast, it seems someone like we're the kind of doom merchant, and we're saying, this is happening, but it's reality. It's reality, and the Fed and the central banks, they're in a really difficult situation at the moment. They're effectively in a no-win situation because they need to control inflation, and to do that, they can do the quantitative tightening, reduce the money that's circulating, and as part of this, they will increase interest rates. But the problem is they continue to increase interest rates. That's going to put more and more pressure on the banks and the stock markets and the value of all assets. And it feels like we're kind of getting close to that tipping point, and it's a lot of pressure on the Fed to do this and manage the situation. There's a lot of kind of speculation what they're going to do now. We have their next meeting is next week, actually. So hopefully the result of that comes out before the webinar.
Yes.
Because previously there were predictions that there would be a 0.5 increase. I think the general consensus now, kind of 85% of the survey is going to be 0.25%. But there's still some saying that Goldman Sachs have been the most vocal, saying that they expect there won't be any hike at all, and the Fed are going to have to kind of pivot on their strategy. So that's going to be a really interesting kind of situation next week. I think they need to be very careful. I can't see any way they can do a 0.5 interest rate hike. It's just it could do some serious kind of damage to the markets, and it's going to put pressure on more banks. And the SVB was the one that we've seen in the press the most, but there's also Signature Bank. I don't read about that one as well. And
there were three, weren't there, in total that have folded in the last little while?
Well, Signature Bank, they've more been kind of seized by the regulators because they were concerned by what they could cover, and their defense is that they could cover their balance sheet, and they were in a strong position, and they believe that the regulators have focused on them because they're heavy into kind of cryptocurrency and things like that.
Yeah.
But yeah, it's not just the one. It's not just kind of Silicon Valley Bank. A lot of the share price of a lot of the regional banks were decimated. I think 60% down in one some, which have rebounded to some extent, but it just shows the panic there is in the markets at the moment.
That rebound's quite normal, though, isn't it? You get terrible news, prices have dropped massively, and then of course that's an opportunity for some people to speculate at that point, isn't it? So that brings a natural bounce back, doesn't it? If not natural.
There's usually kind of two different types of the rebound. So sometimes you get what they call the dead cat bounce, which is a lovely term.
Yes, isn't it beautiful?
Um, but effectively, that said, it crashes down and there's inevitably some recovery, but it's false. There's
Yes.
this dead cat bounce, but then it's gonna, lay on the sidewalk or the
Monty
street or
Python
whatever.
style. That cat
Yeah,
has expired.
exactly. Let's not try to kind of picture that poor cat in that scenario. But then you're right, there's a rebound, and what tends to happen is the markets overreact to news. So these banks and markets overreacted, and then you get the kind of speculators, the traders come in, and it's a good opportunity for them. It's
Yeah.
a risk because they're effectively saying, will it rebound and I'm going to make a lot of money, or if the news is worse, then you could lose everything. So it's a bit of a kind of speculation. It's for your um, traders with a generous kind of risk appetite. But you're
Yes.
right. Yeah, it's often the case that things are tend to be oversold and on the reverse, they're overbought.
If I was
And that, yeah,
sorry, if I was a red brace wearing trader, and thinking to myself, that bank's dropped 60%.
yeah.
I fancy a bit of that. They might get bailed out. They that might be quite a good purchase at the moment.
Yeah, of course. And some of those banks, um, the kind of regional banks, they lost their value simply from contagion effect
Yeah,
because of what
yeah, yeah,
happened to the other banks. And
yeah.
and so if those traders are, there'll be some people who are very familiar with these banks, and they could identify actually. I know what their book looks like. They're a sensibly run bank. Okay, they've been hit by this, but they're going to recover. And some people would have made a lot of money out of that.
Mm.
But it's interesting we talk about trading because, and we're talking about kind of security with money, but it's a bit of a kind of general concept, and this is, um, we're financial advisors, planners, and we're generally quite cautious. We as you know, we stay away from things like crypto and these kind of riskier trades. But there's more and more out there. There's people think, you know what, I can research everything. You can find everything you want on the internet. There's all these analysts out there. There's all the information. I can make my own money, which some people can. But then the SVB, something interesting came out, and there's this guy Jim Cramer. You're aware of Jim Cramer?
Oh, I don't know, mate.
Jim Cramer is from CNBC in the US.
Okay.
So he does a show on investments. Look him up. I've come across him on kind of documentaries and things before. He's very typically American. He's quite kind of, and there might be Americans watching this, so I hope I'm not insulting them. But he's quite kind of loud and brash and vocal, very confident. But
Yeah.
he has this show, a kind of stock market show, and he gives his tips, and people naturally follow this guy. He's an expert. Well, about a week before Silicon Valley Bank crashed, it was one of his top tips to buy. So,
Well, yeah, I was just about to show his show page here. Maybe we shouldn't after all.
yeah. One to avoid, but he's got Mad Money, I
Well,
think, is his
that's it telling, isn't it?
is his TV show, and maybe quite kind of appropriate for it.
Yes. Mad money.
But no, I mean, fair play to him. You can see there he's still kind of commenting on what's happened, and he's probably trying to keep his head down on that tip. But typically, if you're in the public eye, a lot of people will come out and say, right, you said this last week. But it just shows, you've got these experts out there, and there's some good, some bad, somewhere in the middle, but they don't know everything, and it's your money. If you're, even if you're trading, just blindly following the tip of some guy shouting at your TV screen is
Right.
probably not the best approach
Well, Jim,
to take.
having recommended SVB last week, if you email him saying, "Actually, I lost out a bit on that, Jim. Do you think you could help me?" I don't think there's going to be a favourable response. We form an orderly queue, and you are insured up to $100,000 or whatever it is in the United States.
Yeah.
Sorry, can't help. As you say, it's all very subjective, isn't it?
Absolutely, absolutely, and if you want to trade on your own back, it's interesting. I had a call this morning with a potential client, and he's relocating to Gibraltar actually. And one of the last things he came up, he said, "Oh, I just want to try investing just a little bit on my own. I want to, see if I can work out what to do." But the guy, lovely guy, and he didn't even know what to start. Some simple questions, and do your research, I think people need to be careful, where they place their money as well. Crypto was a big one as well, and there's nothing wrong with investing in crypto, but I think you've got to be careful with what proportion of your funds you are using,
Yeah,
and you've got to understand in situations like that you can lose it all. The
yeah,
same if you're buying individual equities, you can lose it all as well. So um, when we talk about the kind of security of your money, you know, investing is part of that. Diversification is key. Knowing what your risk appetite is, making sure you kind of stay aligned with that. Always avoid any because I'm to this guy. I mentioned the app that I use, and they have a normal trading app, but they also have one that's called CFDs. So CFDs is something called contracts for differences. And effectively you can invest in equities, but they leverage up. So you put in £100, they will buy £500 for you. If that goes up, you make 5 times, but if it goes down, you lose 5 times. It's incredibly risky. And the fact that the app that I think I signed up within 20 minutes can allow people to invest in that sort of structure is crazy.
yes, yeah.
Because it's gambling. That's not investing. So people need to be careful with that sort of thing as well.
Yeah, well said. So more on the macro next week. This is the big webinar that's coming up. We'll talk more about keeping your money safe with Matt Penfold from Fiduciary Wealth Management for the rest of the podcast. But just to complete this first section, looking at the global picture, there will be a deep old dive into that at 10 o'clock my time next week, which leads nicely into a webinar Q&A. So make sure you sign up for that. That's the link to it. That will be Fiduciary Wealth Management's macroeconomic environment deep dive, and then we can any questions you've got. I'm sure you'll address a few during the webinar, but we can have a bigger and richer debate, diverse debate in this situation on the podcast straight after. And I'm really looking forward to that, as I'm sure you and Paul are as well, Matt.
Yeah, no, absolutely. And just to point out for people, because I saw the link, it says, get your tickets for the webinar. It is a free webinar. We do these things for free. So yeah, sign up, join us for that. And I think it was your idea last week, Carl, and using the podcast as a follow up to that with some questions and as I say, the timing of the webinar might be quite interesting because we've started to put all the content together, but come next Wednesday, how much of that will be out of date? That panics me a little bit.
Because between now and then, you've got a UK budget, haven't you? And the Fed response in a week where you have had those bank collapses, most notably Silicon Valley Bank. So yeah, you'll be tweaking your notes, I suspect, right up to the last minute. What are you expecting before we completely finish on the global picture? What are you expecting from the Chancellor in the UK today?
I think it's going to be quite relatively vanilla. I don't think there's going to be I don't think there will be too many shocks. I mean, it's his first budget, which I forgot really, because we've had so many kind of chancellors in the UK over the last couple of years. It might be his first budget, it might be a last one as well, like the last guy. Who knows?
It's Jeremy Hunt we're talking about, isn't it? Because
Jeremy Hunt, yeah.
Okay.
I think the big thing is there'll be amendments to how much you can save in your pensions.
Right.
So what they're trying to do is maybe encourage people to return to work and maybe encourage people to work a bit longer. And what they've got at the moment is something called the pension trap. So the pension trap is you're limited to how much you can put into your pensions. So you have the lifetime allowance. So the lifetime allowance sits at 1,073,100. As soon as you put more than that into your pension, and when we're talking about your pension, that's all your pensions combined. That's your contributions, your employer contributions, that's any tax relief. Once that goes over that limit, then you will be subject to quite a hefty tax on that, up to 55% or 25%, depending on how you take it. And over 1 million sounds like a huge amount to a lot of us. But in reality, if you're saving on your pension from when you first start employment, that's going to build up very quickly. And what they're finding is there's a lot of people, a lot of professionals, and they're talking occupations where they need people. Doctors is a good example. They're reaching the top of their pension, so they can't make any more contributions. Therefore, they're missing out on those kind of employer contributions. They're missing out on tax relief. So people who are effectively kind of breaching that and thinking, okay, that's me done for work. So it's quite likely that they're going to increase that lifetime allowance, and they're quite likely going to increase the annual allowance. So the annual allowance is how much you can pay into your pension each year. It's 40,000 at the moment. They think that's going to increase to 60,000. And then the last one is a money purchase annual allowance, and that is once you've started taking income from your pension. So not what we know as the tax-free lump sum, not the 25%. Anything beyond that, as soon as you start taking income, then at the moment you can only put up to 4,000 back into your pension.
Okay.
They call it recycling. You can't put too much in. They're talking about increasing that, and I think again they're looking to see if that can be an incentive to people to return to work. You finish working, you started accessing your pension, you can now return to work and then top up your pension. So I think they're looking to do that. I don't think there's too many changes to taxation.
These are calming measures, aren't they? They're nothing too dynamic or risky or offensive by the sound of it.
Yeah, I mean, the key term at the moment, Carl, is stability. That's what we've been lacking for quite a long time.
Yes.
That's what the Fed is trying to achieve, stability. That's what
Yeah.
the UK is trying to achieve. And stability will be great for all of us who are invested. The markets like stability. And we've had the opposite. We've got volatility at the moment. So I think stability is the aim at the moment. You never know with the budget. There's always some surprises. I was reading something this morning, and I didn't read the entire article, and they're talking about that there's going to be something that will be good for those who have swimming pools. I don't know what the incentive is for that, and we will wait but it's very niche, that one.
It is, but the
Um,
Prime Minister, just to be a bit sort of UK focused at the moment, the Prime Minister just has had some adjustments made to a swimming pool. So maybe it's just friends helping friends. I don't know. We'll see, won't we? And I shall look forward to finding out if your intuitions are correct. Are some of these things based on is how this works? That there are little sort of leakages of what we might do, and you get some feedback from the markets and from the pundits and the economists, and then okay, we'll put that in. Is that how it works with a budget?
yeah, I think so. There's they like to kind of test the market, test the reaction, so they will leak these things and see the reaction, which is the case with a lot of government policy.
So
They
true.
they might try and kind of bury something in the small print to kind of sneak something through. Maybe this is what this swimming pool kind of tax is to help Rishi and that. But there will be the headlines. I think the other big one is they're looking to give childcare help as well.
Oh my goodness!
Um,
I heard what it costs to put a child in part-time or full-time care in the UK. I mean, before you even get to work, you've spent 130 or 260 pounds a week on childcare. I had no idea in this refined
it's
life I live in Portugal.
I think it's unreal, and now at the moment I think if your kids are age 3 and 4, you get 30 hours free a week. I think
Right.
they'll want to extend that to ages 1 and 2. So it's
Right.
another incentive to get people into work,
Yeah.
um, and these incentives help with the economy as well. It puts more money in people's pocket, then people
Mhm.
will be spending, and they're leading to growth. So I think that's what they're aiming to do. They're relatively kind of sensible measures,
Mm.
which we can't often say. Was it last week we spent about an hour kind of criticizing the government. So let's give them credit for this one. It looks like
Bit of balance this week.
it's going to be a
What,
relatively sensible budget. Yeah.
Matt? Why 1,700,000 is it, and £100? Why that strange number for the pension limit?
That's a good question, Carl. And I don't know the answer. It was higher, and they
Right.
kept bringing it down and bringing it down. So it was 2 million at one point.
Yeah.
It was 2 million, then it went down to 1.8, and then it gradually went down, and then it went to 1 million, and then
Yeah.
I think it was increased one year in line with inflation. So that's why we
Oh,
get
I
that.
see. That's why you get the odd
That's
figure.
that's why we get the odd figure. Yeah, I think that's what it was.
Superb, brilliant roundup. Let's see what Jeremy Hunt comes up with. Always pausing, as other broadcasters must do before saying his name, famously. We're gonna talk some more about keeping your money safe then, with what's been going on, and as a general rule, you say fiduciary wealth management. Of course, you have a steady approach, and I think you use the very important distinction of there's investment and there's gambling. And I like you, I can't believe that there are apps available that actually, it's like being on a bookmaking app, isn't it, rather than an investment app. This is your approach. Tell us more about fiduciary wealth management's approach to working with people and their money, and the steadiness that you offer.
Yeah, I mean, it's today wasn't really the intention to kind of promote too much what we do, but I think one thing that we offer is kind of peace of mind, and I think especially for expats and you're moving to a different country, but a different kind of financial situation, and that's what we want really in truly with our clients. We talk about kind of trust is a big element of what we do, but it's not about saying, okay, give us your money, we do it there. We want to know, right, what's best for your situation, and what will give you a peace of mind. I mean, we had a very good example of someone we've been talking to this week, and he's actually been talking to a couple of other firms, which everyone has the right to do, and they should, and assess their options, and that helps us because we can demonstrate the value that we offer. But this guy, and I won't give too many details, but he's in the UK. He's moving to Portugal. He's going to be there for 10 years, which I think you probably know why 10 years. Then he's going to return to the UK.
Yeah.
And so we're saying we don't want to just look at your situation. Okay, let's invest something that's Portuguese compliant. No, we need to invest something that's Portuguese compliant, but then can help you when you return to the UK. But also, think about your legacy as well. This guy's got a family. He's about 10 years older than his wife. Chances are that she will outlive him as well. So it's looking at that kind of longer picture as well. So, you've got that peace of mind for the long term. When we're talking about security, I think it's something that people need to be aware of. Most people need to be aware of, but what's happened with the US banks is important, that, keeping all your money in a deposit with one bank is foolish.
Yes.
So they have, in the EU, they have the EU deposit guarantee scheme. I think it's 100,000 euros. In the UK, they have a similar scheme. It's 85k in sterling, so roughly equivalent. And effectively, this protects your deposit with that particular bank. So you shouldn't keep more than that in a particular bank. And you should also consider the type of bank that you're using, because the banks themselves have their own kind of credit rating, and you should be looking to deposit your money in a secure bank that has a high credit rating. And this is generally, AAA, a AA credit rating, and effectively
of Marks and Spencer end rather than the market trader end.
Exactly, yeah, because what these ratings tell you is how likely is a bank going to default.
Yeah.
And then if the bank defaults, then it could potentially become your problem. Now, there are kind of protections in place, and we've seen with what's happened in the US, they've actually come out and they've said they're going to compensate everyone's whole deposit, even if it was over their limit. And I think their limit is higher than ours. It's 250k US dollars. But just because the US are in a position that they can do that doesn't mean it would happen in the EU. Probably unlikely to happen in the EU nor the UK. Make sure that you don't deposit money that's over that limit with one particular bank. There's also the other advice is that if you've got a money of that amount, is the bank the best place for it? Probably not.
What do you mean in terms of the value, your value for money, and the effectiveness of your asset?
Exactly. So less about security, more about it's still out there. Inflation is raging. So unless you've got an interest rate that's beating that, you are effectively losing your money year on year. And I know how it works in Spain, and I'm sure it's pretty similar in Portugal. Carl, is that the banks don't offer too much. It's low interest. unattractive kind of schemes to look after your money. So there are other options out there. So I think you need to strike that balance of there are some people out there who should never invest in the stock market. They don't like it. They've got a super cautious risk appetite. They're a 1 out of 10 or whatever. And for those people, they just have to accept that, okay, their money will be in the bank. They know what they've got in actual terms. In kind of real terms, it's going to reduce each year because of inflation, but that's a trade-off you do. Whereas other people, and as I say, we're not short-term traders. We're looking at the long term. So you should be investing for a minimum of 5 years, and that's how the performance should be assessed. Because, and we're completely honest with everyone, the market goes down, the market goes up. As long as you have the patience and the time scale to endure that when the markets go down and not panic, then history tells us, the markets will go up over time, as long as you've got a sensible allocation within your investments. And just go back to the investment side, actually, Carl, because we saw what happened with the banks, and there was a drop in the value of the S&P and the Nasdaq and the FTSE as well. Whereas assets that we've been talking about for some time, gold and silver, they picked up very well. And it's because people are looking at safer alternative assets, and in times of panic, gold and as a byproduct, silver are very attractive. And that's a game where a sensible, diversified portfolio can work in your favor. It's not just, okay, just because you're investing in a Spanish bond or a pension or just a general investment account doesn't mean everything has to be equity linked. You can be invested in a gold ETF or a gold miners or silver, something like that. And that further diversifies your investment portfolio, which reduces your risk. And we do analysis of portfolios for external companies. And that's one thing that we look at, the risk reward. And it sometimes we see these portfolios and there's this real imbalance of people are taking too much risk for too little reward. It always needs to be kind of reversed, and that's what it should be, the aim: little risk, greater reward.
Get that balance right. Now, I've got a question kind of based on that, because a wine analogy comes to mind, strangely enough. That, if you for the very risk averse person who is happy to put their money in the bank at the moment, with inflation at around 8% here in Portugal, and the biggest interest rate maybe 2% return on their investment. That's like giving somebody a bottle of wine to look after, and when they give it back to you, they've drunk some of it, isn't it? It's like, and that risk averse person would say, well, at least I got some of my wine back, and it was safe. All the time the bank had it, it was safe, and I had my amount of insurance that I could claim against if something went wrong. How much do you, or how much effort or how difficult is it to then move from that, as you said, 1 in 10 types, personality perhaps, into making it worthwhile to take some risk and get more wine back than you put in, if you like? I mean, I guess, is it too difficult to answer that question?
It is a difficult one. It depends on the individual, really. Some people can't shift that mindset, and that's not a problem. I think they need to be honest with themselves, and it's not a critique, and it's not an issue. But I've had clients before, and we had to have an honest conversation, because they said, "Oh, I looked at my investment yesterday, and I looked at it today, and then I look at it tomorrow, and the value is going up like this." And you're saying you shouldn't do that. And if you're the sort of person who does that, then I think it's always on your mind. You need to be able to, and maybe that sort of person is better with the money in the bank, and then you know what you're getting without a doubt.
Okay.
But it's difficult to shift that mindset. But I think what people forget is that, a lot of us have our pensions, and our pensions are invested in that way. So we still have that exposure without even
without
knowing
knowing
it.
about it. Yeah,
But
fine.
yeah, some people, it's difficult to change their mindset. There's a lot of people that are just, especially from the UK, are very attached to property in his investments.
Mm,
And it's difficult to get them to kind of consider other options. I think more and more people are looking at other options because being a landlord in the UK isn't as attractive as it used to be,
sure.
and especially for expats, you come to. I don't know the property market in Portugal that well, but in Spain, for example, it's not really kind of set up from an investment side. People, there's high costs when they buy their property. People tend to, stay with their parents until they're much older than they should have. Then they, get married, they buy their first property and stay in it for the rest of their life. Whereas in the UK, it's a lot more kind of fluid, and
Yes.
that stimulates the market. So it's some people have they're more open to changing their mindset. You still get the odd person who says, I don't even trust the banks. I'm
Yeah.
going to have all my money, under my mattress, and
Bank of the mattress. Yeah.
exactly, yeah, and that comes up with, even different risks. So
You
yeah,
make a point. You made a point that I've not really heard before, and I think it's a great one. If you are going to bother to take your money out from that safe situation, you do want a decent return on it. Otherwise, what's the point?
of course, yeah, of
Yeah.
course, yeah.
Yeah.
It, you've got to consider the return, but also from a taxation point of as well.
Yeah.
There's no point in investing this money in a inappropriate situation, and then you're going to get kind of taxed to high heaven on it as well.
Yes.
So yeah, and I think that's why it's important, and shameless self promotion, that you work with a company that knows what they're doing, that you can trust, that can give you, truly kind of independent advice on what your options are, and that's what we aim to do.
Okay, we know we've had some viewers today, and do feel free to ask any questions you've got. Any questions? There is no such thing as a silly question here, and your question will be dealt with respectfully and sensitively. I suspect there'll be many more questions next week when we follow up on from the macroeconomic environment review and deep dive, and make the podcast an extended Q&A about that. So yeah, feel free in the remaining minutes of this podcast today to ask any questions you've got, but certainly bring your questions after watching the webinar next week. Anything else for us, Matt, then, on keeping your money safe?
No, not really on keeping our money safe. Just a kind of few smaller bits I wanted to cover today. So a bit of a end of the podcast roundup. Firstly, for those people with their questions, feel free to send them ahead of the time in the week to our email, or
Okay.
I don't know. Yeah, there's upcoming events this week. So we've got the Fed next week. We've got the budget today. We've also got the European Central Bank. They've got their announcement is tomorrow. And I think they were looking for a 0.5 increase, but the talk is now that's going to be 0.25 as well. So they're kind of slowing things down as well. But the problem is, it's still not going to control inflation. But one thing I wanted to talk about very briefly, and maybe we'll cover this in more detail in another podcast, is and this is very much related to money and finance for expats, is um, FX exchanging your currency. Because I've seen some terrible situations before, and um, you need to be very careful with this, because we were aware of a couple, and they were exchanging, and they weren't particularly financially savvy. They received a quote from one of these currency companies, and they gave them this quote, and they said, it depends on the rate that day, blah blah blah. And then when they exchanged, they went through it, had the phone call, they agreed to it, and they just agreed and trusted these people. And these companies, they make their money via the spread, the
Yes.
difference between the exchange. And the spread that this company charged these people was unbelievable. So you've got to be. I think people don't understand, when you're exchanging large amounts of money. Maybe you've sold your house in the UK, and you want to move it across. Just be very careful who you are using for those exchanges, and also have someone that you trust. Maybe use someone that has been recommended, that somebody used them before. Be very careful that if your mortgage company or your estate agent is saying use this company, because it's quite likely that they get an incentive to recommend them. And just be very careful that when they do make the exchange, that they disclose everything. They say, okay, here's a rate. What is the spread? Ask these people, okay, what commission are you taking out of it?
Yeah.
Put them on the spot. There's never be afraid to ask those questions. We welcome them as part of this podcast and during our kind of day to day, but ask those questions, ask those uncomfortable questions. And if
Very
these people are working for you, then there's not a problem. But one question, very simple question. Somebody asked me the other day. We was in Spain, and they were using a kind of British bank card, I think a credit card, which a lot of people still do. I still use a British credit card at times. And you go to pay at the supermarket or the restaurant, and it comes up that question: do you want to pay in euros or sterling? And some
Yes.
people don't know the answer. What would you go for, Carl? Let me put you on the spot.
I would not let them do the exchange for me.
Yeah. So you pay in the euro. Exactly.
Yeah.
Exactly.
Yeah.
Which is the right answer. So if you're paying in euros, leave it, and you pass the test there, Carl. And
Thank you.
what made that stand out for me this week was I was booking some flights to go to the UK, and I was using everyone's least favorite Irish airline because they're the cheapest for that. Well, no, I'll be honest. I don't want to complain about them too much because I use them, and you
Yes.
know what it is.
Yes.
But for the first time, because I was booking in Spain, and so the price was in euros, and they asked me this question, but the default was that they were going to do the exchange, and
Ooh,
it gave me the price, and then and I'd never noticed it before, so I changed it, and then I looked how much it was going to charge me in sterling, and the price difference was something ridiculous, like about 5%. I think it was on a cheap flight they were going to take another tenner out of me,
yeah.
and they will squeeze everything out of you. Everyone knows the airline I'm
That's
talking
how
about.
that's how they make their money, isn't it? On those, if they do that to 10 people in a row, that's not too bad, is it?
They'll make
Yeah.
a fortune, and it kind of surprised me. So yeah, I think is a very short question, but somebody asked me this week, so I thought I'd share the knowledge with everyone. But yeah, don't
That's
let
really
the
helpful.
restaurant or the company do the exchange for you, because
Well, it's funny you mentioned restaurants. People deliberate more which restaurant they're going to than the currency company they might use.
yeah,
In the example you gave, and people know, don't they, because of this same phenomena of not letting the bank exchange it for you, because banks aren't very good at exchange, are they? Let's face it, they're
yeah,
slow. It's not their core business, is it? So when they do it for you, they make it worth their while. And so
yeah,
that's created a space for lots of currency exchange companies to come along and work, as you say, in the spread, and getting their money from the difference that they're buying and selling at. But people lose their minds, don't they? Moving from that old-fashioned bank situation to exchange their money, and it used to be the post office, didn't it? Or Marks and Spencers again, to mention them again. And it's gone into a kind of Wild West situation where people seem to lose their minds and just think, "Wow, I could be, having a much better deal with this company that I've never heard of, that no one else has ever heard of," and they entrust these big amounts of money to those companies.
is crazy, and this isn't against those currency companies, because it is wise to use these companies,
Yes.
but
No pun
you need.
intended. No pun
Yeah,
intended.
yeah. I thought you might pick up on that, but you have to be careful that you are getting the best deal, because the problem from what I've experienced with these FX currencies is they don't have a fixed price. They're not saying, if you go to them and say, "Oh, I don't really know about money, but I'm exchanging," and then the next caller they deal with is, I worked for a bank for 20 years, I know, blah blah blah. They're probably likely to give them a better price than you, because they know they can get away with that, and maybe there's a small element of taking advantage, and they can hide behind this cost and this spread, and this couple, the story I told you, and we couldn't do anything about it because we weren't involved in that transaction, but we did approach them, and all they said was, Mr. and Mrs. So and so, they agreed to it. There you go.
Yes.
And
That's
and, and that's it. And there's very little kind of recourse with that.
And you make a good point. I mean, there are some excellent currency exchange companies that have arisen
Yeah.
in the against the backdrop of the banks not doing it very well. Get a testimonial. Go with good word of mouth, because there are some excellent companies for sure, and they, some of them have cards and all sorts of things that are a far cry from when we used to go to the post office and change our pounds into francs back in the day, Matt.
Yeah, and some of the apps are brilliant. I use one of the apps for mine because I get paid in pounds because I work in Gibraltar. My bills are in euros because I live in Spain, so I need to do an exchange every month. And some of the apps are brilliant because it's very well. The one I use is Revolut. I will say the name. And when you do the exchange, it's flickering up and down. It's kind of telling you, okay, this is what it is, and then you press the button. It's a bit like we're saying about the trading. You press the button and then it's done. But it's they're very it's very clear what you're getting. That's what I would say. So it's they are good.
I'm a big fan. I've got to say, that's not a recommendation or endorsement, but it's certainly a good personal experience. Matt, great job today, keeping your money safe. If you joined us late in that, well worth rewinding and reviewing the podcast today. And the big news, of course, is that next week there will be the macroeconomic environment webinar. Join us after that here in this podcast environment to ask your questions live and to pursue and chase up on anything that you wanted clarification or even controversy around. It could be fun and spicy next week on the podcast with live listeners asking those questions that arise from the webinar. So have a great week, Matt. You and Paul planning that, and as you say, things changing quite dynamically for the rest of the week, and hastily changing your notes for the presentation, I'm sure, next Wednesday morning.
Yeah, no, we're looking forward to it. Even if there might be a kind of a bit of a last minute change to some of the content, but it would be good. So those of you watching now, please join us and spread the word. I know it's not, you're down the pub with your expat mate, so you're going for a coffee and oh, these guys are doing the webinar or the podcast, but it's easy to do. Subscribe on YouTube. And you get the notifications and get your friends on board. They may appreciate it, and we would really appreciate that.
But I think economics and big picture and money and finance issues. Sure enough. A few decades ago, it was left to wood paneled rooms, wasn't it, where you let other people talk about that. But it is getting sexier, I think, and I would like to think that you and Paul are part of making that whole money and finance scene sexier. So thank you very much today, and we look forward to the webinar.
Thanks, Carl. I think we're note today the first time ever that me and Paul have been referred to as sexy, but we will take it. But I think that's the one thing actually. A last comment. We talk about all this economic instability and what's going on in the last few years, and that's probably the main reason we started this podcast. And maybe when all this goes away and there's all this stability, we will come on every week and we'll do 2 minutes. We'll say, yeah, everything okay? Yeah, everything's okay. Okay, see you next week, sort of thing. But yeah. Time will tell, yeah.
If only. Thank you very much for that. Take care, everybody. See you next week.
Cheers, Carl. Bye-bye. Bye.